The crude markets have been sending mixed signals since last Monday, with WTI bouncing between technical support and resistance like drill bits hitting alternate layers, shale, limestone, granite. But here's what the data doesn't tell you about where we're headed. Now, I've spent several decades navigating diverse corners of the upstream oil and gas industry, from boardroom battles to witnessing the occasional fistfight on rigs, from petroleum club negotiations in back room between oilmen and financiers and lawyers. But what I'm seeing now isn't just another market cycle, it's a fundamental recalibration of how this industry operates. Let's start with the numbers that matter. WTI sits at 63.77 per barrel as of September 3rd, down nearly 2.9% for the week and tracking 9.2% below year-ago levels. Henry Hub natural gas is trading at 287 per MMBTU, showing the volatility that we've come to expect, but with an underlying strength that suggests more than seasonal demand patterns. Brent crude mirrors WTI's weakness at 67.40, creating a spread that tells us regional dynamics are shifting. But prices are just symptoms. The real story lives in the operational data. The U.S. rig count stands at 412, barely up from last week, but down nearly 15% year over year. That's not decline, that's discipline. We say natural gas rigs at 119. Well, that shows similar restraint. Yet, here's the contradiction that drives this industry's evolution. Production continues at record-setting pace despite fewer rigs. The efficiency gains that we've been tracking aren't just theoretical. They're measurable, scalable, and they seem to be rather permanent. The supply side is where things get interesting. U.S. production has been remarkably resilient despite the Permian's geologic challenges that we've been tracking. Output is held steady at record levels, just marginally below the all-time high set about a year earlier. This isn't an accident. This is the result of technological advances that have fundamentally altered the economics of extraction. Meanwhile, the corporate landscape is experiencing seismic shifts that go beyond typical market adjustments. ConocoPhillips just announced plans to lay off 20 to 25% of its global workforce. That's potentially 3,250 employees before year end. These aren't just cost cuts, they're structural realignments following a period of unprecedented consolidation. The M&A wave that defined 2024 continues to reshape industry architecture. ExxonMobil's $60 billion Pioneer acquisition, Occidental's Crown Rock deal, these weren't just transactions, they were statements about scale, efficiency, and long-term positioning. The industry has moved $105 billion in upstream assets, creating new competitive dynamics that smaller players must navigate. But consolidation brings consequences. The same efficiency driving production gains is limiting redundancies, human and operational. What we're witnessing isn't just corporate restructuring, it's industrial evolution accelerated by technological capability and market pressure. Technology tells perhaps the most compelling story. Permian operators like Chevron and ExxonMobil are deploying digital automation, AI-driven analytics, an advanced water recycling system that would have been science fiction just a decade ago. The USGS recently identified 473 million barrels of technically recoverable oil and 27 trillion cubic feet of natural gas in Wyoming, Colorado, and Utah's Mowry system. Discoveries enabled by technologies that can seed deeper and extract more efficiently than ever before. The Department of Energy's $35 million commitment to 42 new projects spanning grid security, AI integration, and advanced manufacturing underscores federal recognition that energy and technology convergence isn't optional, it's inevitable. Global factors add complexity layers that domestic operations can't ignore. OPEC Plus is unwinding voluntary production cuts, adding 547,000 barrels per day in September alone, on top of 2.2 million barrels per day returned since spring. Saudi Arabia boosted output by 230,000 barrels per day to 9.6 million in August. These aren't market corrections. They're strategic positioning moves that U.S. producers must factor into every capital allocation decision. Meanwhile, eased sanctions allow Chevron to expand Venezuelan operations, adding modest but strategically significant supply that benefits Gulf Coast refiners. Geopolitics and geology intersect in ways that create opportunities for those that are positioned to capitalize on regulatory and diplomatic shifts. Here's what the numbers reveal about transformation. Companies are borrowing to fund shareholder returns while simultaneously reducing operational headcount. They're investing in carbon management and industrial gas projects while maintaining record production levels. They're consolidating assets while discovering new resources through advanced geological assessment. The message becomes clear. Adaptation, as I've said, is non-negotiable. Tomorrow's winners won't be those drilling the most wells, but the smartest wells. Technology, efficiency, and disciplined capital allocation form the new currency in an industry evolving faster than conventional wisdom acknowledges. U.S. Energy Corp's transition from traditional oil and gas producer to vertical integrated industrial gas supplier exemplifies this evolution. Their Montana-based Kevin Dome project targeting CO2 and helium revenues represent the kind of strategic pivot that transformed commodity exposure into value-added services. Ring Energy's $18 million debt reduction targeted for Q3 reflects industry-wide focus on balance sheet strength over growth at any cost strategies that defined previous cycles. Financial discipline now drives operational decision-making in ways that prioritize sustainability over spectacular quarterly results. The industry's relationship with capital has fundamentally changed. Where previous cycles saw boom-bust patterns driven by commodity price volatility, current operators demonstrate remarkable consistency despite price weakness. This isn't just better management, it's structural transformation enabled by technological capability and reinforced by market discipline. Looking forward, several trends deserve attention. First, the efficiency gains driving current production levels appear sustainable and scalable. Second, consolidation has created operating entities with resources to invest in long-term technological advantages. Third, regulatory and geopolitical factors continue creating opportunities for adaptive operators. The sector's resilience stems not from traditional boom cycle dynamics, but from fundamental operational improvements that maintain profitability across broader price range. Innovation in extraction, processing, and distribution creates competitive advantages that compound over time rather than dissipate during down cycles. What we're witnessing isn't just another energy transition, it's the emergence of an industry that combines traditional resource extraction with advanced technology deployment, creating operational capabilities that previous generations couldn't imagine, and profit margins that previous cycles couldn't sustain. The future belongs to the operators who understand that drilling expertise must integrate with data analytics, and geologic knowledge must combine with artificial intelligence, and that financial discipline must support technological investment. The glitch in the system isn't market volatility, it's the gap between traditional thinking and technological capability. I'm Mark Roach, and this is Future Wise Energy, where tomorrow's industry analysis starts today.